Hi, welcome to week 3 of this course. You will recall in the first 2 weeks we looked at the banking aspects of this course. From here on we would be looking at the financial markets aspects of the course. Financial markets are basically markets, both real and virtual, where financial instruments of varying maturities are traded. By that I mean these instruments can be bought and sold. Instruments traded in the financial markets include overnight instruments such as call money and Fed funds, short-term instruments with maturities up to 1 year such as treasury bills, commercial paper, etc., long-term instruments with maturities up to 30 years such as government securities, corporate bonds, and so on, and last but not the least, perpetual instruments such as equity shares. Financial markets facilitate price discovery, and by that we mean markets determine prices and yields for interest-bearing instruments, price for equity shares, etc., based on factors such as projected cash flows and risk profile of the issuer, interest rate expectations, liquidity, news flows, etc., in a free and transparent manner across markets. They are broadly classified into short-term markets and long-term markets. Short-term markets include call money markets or Fed funds as it is known in the United States, treasury bills market, the repo market, bankers acceptance or commercial bills market as it is known in some countries, commercial paper market, certificate of deposits markets, and so on. The one thing important about the short-term markets is the maturities for instruments traded in the short-term market vary from overnight to a maximum of 180 days, in some cases up to 1 year. These markets almost universally are also commonly referred to as money markets. The long-term market, on the other hand, primarily refers to the government securities market, the equity stock market, and the corporate bond market. In the long-term markets, the maturities for instruments traded vary from 1 year to perpetuity. In other words, they don't have a maturity date. These markets are commonly referred to as capital markets because financial resources raised in these markets are often used by firms to fund their long-term capital investments and by governments to fund their fiscal deficit as well as long-term investments in infrastructure development, so on and so forth. In addition to the markets that we saw, there are some very specialized markets. These include the foreign exchange market or the currency market, where different currencies are bought and sold. The derivatives market, where more complex instruments such as options and futures are traded either to hedge or to speculate on the movement in interest rates, exchange rates, etc. Then there is the private equity market, which is very recent in origin, by the way, when compared to the other markets. This is where institutional investors and high net worth individuals invest in private equity funds, popularly referred to as PE funds. These PE funds in turn invest in the equity shares and sometimes in the debt of listed and unlisted companies. Such investments are generally held for a long period, 5 years or more, and sold off for a profit once the financial performance and consequently the value of the firm or the share price of the investee company improves. And finally, we have the mortgages market, where individuals and organizations take loans to buy property, i.e. real estate. These loans are then packaged together by the lenders as mortgage-backed securities, MBS for short, and sold to financial institutions who in turn trade in these securities. Do bear in mind that short-term or long-term in the context of financial markets and instruments refers to the maturity period of the instruments issued. They do not refer to the holding period by the investor. For example, an investor could buy a corporate bond of 15 years maturity, which is a long-term instrument, and sell it at the end of 90 days, i.e. in a short period, and he books his trading profit or loss. In this case, the instrument is a long-term and hence part of the long-term market or capital markets, but the holding period is in the short term. In several videos to follow, we will look at the nature and composition of each of these markets, both short-term, i.e. money markets, and long-term, i.e. capital markets. We will look at the structure of each of these markets and the instruments traded in these markets. We will also look at how equity share prices, yields on interest-bearing instruments, exchange rate between currencies, etc. are driven both by the underlying well-rooted theories of finance and market forces such as global and country-specific macroeconomic factors, investor sentiments and expectations, risk profile of the issuers, news flows, etc., all of which are dynamic and vary with time.